Well, hello, everybody, and thank you for joining us for this week's episode of Your Mortgage Process. I'm, of course, your host, Greg Wareham. So, you ever wonder, how do I become a multimillionaire? And in my experience, people have accumulated a seven-plus figure net worth. They've really kind of excelled in a few different areas. Some's real estate, right? Rental, property, value appreciation, leveraging other people's money. Number two, business owners, which is a great industry or a great way to go about building equity in something, driving big revenue, but it also comes with high risk. High-end job, you're a CEO, you're a Wall Street person, executive, celebrity, athlete, and investing in smart financial planning. Now, any of these, when managed correctly, can skyrocket someone's net worth. And many people with wealth have likely mastered several of these or all of these. So for today's show, I wanted to focus just on one area, disciplined and focused financial planning. And in the big picture, one specific financial plan, it doesn't fit everybody, right? Financial planning is a product of someone's individual goals, age, risk tolerance, along with a ton of other criteria that our guest today will talk about. Now, when you look at time value of money, to me, that's like the eighth wonder of the world, right? You start with a small amount of money, it becomes a big amount of money over the course of time, given the right investment strategy. And I'm going to give you a quick example of that. So let's say somebody wanted to have $1 million. If they were to save $35 a day over 30 years, earning a 6% rate of return, now we've accumulated $1 million. You operate in the presumption that you haven't paid taxes on it or anything like that. Now, to put that into perspective, that gives the individual a total investment of $385,000, and they would have earned dividends or interest of $615,000, right? It's like magic. And what did you really do? You hired the right person to work with to be able to accumulate that over the course of time. Now, again, everybody's different, so I don't want to minimize that cost per day, but with a disciplined expense management and the right plan, it can potentially be achievable for anybody. Now, time, in my opinion, is your best friend when it comes to a disciplined financial plan. In that same scenario of $1 million, if you could achieve that over 40 years with an investment of under $20 a day, and you can imagine what 50 years does, or bigger investment over a shorter period of time. But in order to help shed some light on a comprehensive financial plan, I'd like to introduce our guest today, who's an expert in this area, Chris DiGregorio.
Greg, thanks for having me. I truly appreciate the opportunity to speak to people about this subject. And financial planning is generally what I've been doing, what I'm specializing in. And it's interesting. At the beginning of my career, I didn't process really what a good quality financial plan would be. But over time, I learned that sometimes planning is actually more important than the investment themselves.
Sure.
So, when I speak to somebody, like you said, there's so many different things that come into a financial plan, which people aren't really expecting. And when they sit down and they do a plan with me, and we go through that process, there's a lot of things that come out that they've never really figured
Oh, sure.
out.
Yeah. You got to go deep on everyone to figure out exactly what they're trying to accomplish, short, long term. What's your background, Chris? How did you get into the industry?
Yeah, so about 22 years ago,
Okay.
I've been in the industry over 2 decades now. I really just kind of fell into it. I had gone to college, I got my business degree. I came out with like a lot of people who have a business degree, didn't know which aspect of business I wanted to choose. Started thinking about accounting, but didn't like the idea of sitting and kind of crunching numbers all day.
Sure.
So
Well, that sounds like fun.
yeah, terrible. At least for me, at least
No,
for
I get
me.
it. Preaching to the choir.
Yeah, so I decided at that point to take some financial planning classes, some other classes outside after college, and at that point, I just liked it, and I liked the fact that you could help people.
Sure.
And we're not working with anything tangible. So really, now that I'm working with I worked with a grandfather, and now their kids, and
Right.
now their kids, and I'm working on sometimes third generation, and now kids are going to school on the planning that we set up 2 decades ago. It's just
Great,
really
Chris.
exciting to me.
Yeah. How rewarding is that?
It's
right?
really rewarding. Yeah.
Yeah, no, I can imagine. So, and I know you work for a huge company. Everyone will recognize the name. We're not going to mention it today, and you're extremely successful in what you do. Now, I know that it's different for everybody, Chris. depending on your individual goals and a couple of things that I already mentioned. What does a comprehensive financial plan look like? Like, what are the broad strokes?
All right. So I think when people hear the word financial plan, a lot of people pull back, right? Because they think of this, and some of my competitors do this. They throw together 100 pages of financial planning with every graph and every chart and every possibility that could possibly come. All right. So when you say what my financial plans, all right, I try to break them down, all right,
Okay.
into a couple different parts. And it starts obviously with assets, and then it goes down to, you could break it down to the assets, needs and wants of the clients and goals, obviously the most important.
Sure.
That's what they've worked their whole life to get to. The biggest part of financial planning right now is how long are we actually planning for? Because when I did a financial plan 20 years ago, all right, we were planning for 20 years in retirement.
Right.
Now we do a financial plan today, we're planning for 40 years in retirement.
Right.
So you were talking about time value of money. Well, it's the same type of thing, right? I mean, you have to really plan for some plans are longer than the people worked for. We've actually planned for.
Wow.
So when you say what does it look like, it looks a little bit different for everybody. But the way we do our plans is we start out, like I said, with assets, goals, needs, wants, and then we really, and then obviously hypothetical returns, risk tolerance, and then we work into cash flow distribution, which in any financial plan that I've worked with, cash flow distribution, which is each year, how does cash flow come into you, right? Either through Social Security, pensions that you might have had, through your investment income, real estate, or any other, items that they get as far as cash is concerned.
Sure.
That's what is the most important, because they can see how that distribution changes over time, how inflation works over time.
Yeah.
Okay.
Well, that's important. You look at like today's day and age with inflation being so high. Now I know it doesn't meet the average, but you got to be prepared because some products, the inflation is going to impact more negatively than other products, right?
Yeah, a huge aspect of a financial plan is inflation. When someone says to us, we need $100,000 a year to retire comfortably and be able to do what we want and live the way we want to live, that $100,000 in year two is $103,000.
Right.
And that $103,000, $106,000 or better, if you're compounding it, because a $200 meal today is going to cost $400 in 20 years. So
maybe 10.
So, right, exactly. Maybe I don't know what it's going to cost. So the point being is, if you're not building in that into the plan, and somebody just says, I need this set number, a lot of people don't understand the time value of money and how that inflation is eating up their savings.
Yeah, no, and that's a fantastic point, because inflation rate is going to be 2% historically, right?
Yeah, we use 2 to 3% on our plans. Yeah,
2 to 3. Yeah. So now you're earning 3% on your money. You're breaking even.
That's right. And then depending on if they have qualified money, which is anything in an IRA or anything in a 401k, all right, or non-qualified money. The non-qualified money is going to be taxed when they take money out of it, and qualified money is going to be taxed when they take money out of it. So if they haven't planned properly and they don't have maybe some tax-free buckets or other income, now taxes are getting taken into account as well. So you have inflation eating it up, and then you have taxes eating up the distributions.
Right. Well, let's talk a little bit about a 401k. So are you from the school of everyone should be maxing that out? Like, what do you think about a 401k as an investment?
Yeah, so a 401k is important. I think you got to really look at there's a couple problems with 401ks. There's pros and cons to anything.
Sure, yeah.
All right. So I think 401ks are probably one of the least managed assets, okay, that anybody has, but probably one of the biggest assets people retire with.
Sure.
And why is that? Well, I think most people don't get a lot of education, if not mostly all people don't get education on their 401ks. And that's one thing that we try to do, is really educate people on their 401ks and pull that into the financial plan in the process. But you really have to look, number one, into the company and what they're contributing to the 401k.
Sure.
If you have a company that's not contributing any sort of match into your 401k, you're going to think differently than a company who's matching the first 4% of contributions. So, a company that's matching 4% of your contribution, you put in whatever the number may be, let's say $10,000, and they're giving you $400 or whatever their income's $100,000, let's say, and they're contributing $4,000.
Sure.
You've made 4% on your money year one.
Right.
That's something to look at, and I'd say you'd probably want to, you'd probably want to at least hit that number, so you're getting at least that match number.
Sure.
All right. But if they're not contributing anything to the 401k, then you may look at it differently and look at other avenues of where that money to go.
I have a question for you about that. So you look at a 401k, and if you have a company that's not matching your 401k, and you're just you're in the 401k plan, whichever company they choose, right? The employer chooses. If you didn't put the money in there, do you have the ability to then self-fund an IRA for an equivalent dollar amount?
Yeah, you could.
Okay.
So if you're not in a 401k, you could go into an IRA.
Okay.
But business owners, you had mentioned business owners as part of accumulating wealth. Business owners have a lot of other opportunities that if you're not working with the right planner and you're not putting together a good financial plan, you may not see.
Right.
So that plays into a self-sponsored IRA, like a SEP IRA.
Sure.
You could do. A lot of people do some type of insurance policy, like a variable life, where you could put money away and then borrow off that money tax-free down the road.
Right.
You could set up, an HSA account. All right. You can employ children. There's a lot of other ways that you could. So a W-2 employee, we're going to plan differently than a business owner 1099
Makes
employee.
sense.
Yeah.
I mean, W-2 is like the worst because
worst.
W-2, you're never going to pay more taxes than if you're a
it.
W-2 employee.
That's it. There's nothing to write off. You write off too much, you fall into AMT, and that's it.
This is why Nick won't let me hire him as a W-2 employee.
Yeah.
So now in the thought process on that qualified retirement money, the IRA, the 401k, it's that when you retire, your tax bracket should, in theory, drop.
In theory,
correct?
right.
Okay.
So in theory, and it depends, again, if they're doing a lot of real estate and they're bringing in a lot of rental income, maybe not so,
Okay. Good point.
Right?
Yeah.
If their pension is real high, maybe not so. It really depends, on how their distributions are being taken in their retirement. And that is a major part of financial planning, is how are we going to distribute the money in the most tax effective way
Yeah,
possible.
and you've mentioned that now a few times, and that's gives me a lot of clarity on it.
Yeah.
It's all about the distributions at the end, because someone because I think about it and say, oh, tax bracket drops, so you should be in a better position when you retire and start to withdraw that money, but it's not necessarily the case. It depends on the whole financial picture.
Correct. And in a lot of 401ks, especially the ones that we build out for companies, and the ones that are being built out today, generally, even if we're not building them out, if we're not involved, they all have a Roth contribution, or most of them have a Roth contribution segment of their 401k.
Right.
So if you take a high earner who's really not taking a major benefit from that $20,000 or $26,500 that they could put away, they really don't need that tax benefit now. They should be maxing out that part of the Roth portion of their 401k, which is not limited to the amount of income that they get, where they couldn't do it outside. And I can't tell you how many people just actually miss that.
Well, you know what? Let's talk about that in a little bit more detail, because you have your Roth IRA, and if you're married, there's still limits that you can put into it every year.
Yeah,
correct?
that's right. That's right. Well, yes, there's limits to it, and there's the limits of amount of income that you could receive in using a Roth IRA.
Got it.
Okay. One strategy that we use that a lot of people don't know is what's called a backdoor Roth IRA.
Okay.
And it really comes in, it's very timely right now, actually, for us. We're speaking to a lot of our clients about it, because what happens is when the market goes down as it has, what they could do is they could actually take money from their IRA, all right, move it into their 401k. There's a portion that they could move into their IRA, all right, pay taxes, because they don't have to pay taxes, but they actually move it into a Roth IRA, not a regular traditional IRA.
Okay.
So we recommend that to people when the market's down, because obviously they're paying taxes on a lesser amount.
Yeah, no,
And
that
it's
makes
something
sense.
that a lot of people don't know.
Now, if you were to move that money and pay taxes, is that subject to a capital gain tax, or is it your regular income?
It's subject to a taxable gain tax.
Okay. All right.
Yeah.
Well, that could be really super beneficial.
Absolutely.
Yeah, we got to talk in more detail.
A lot of people don't know about that, and this is a very timely time to do it. You want to do it when the market's down, not when it's up, and you're paying the taxes on the higher amounts.
Yeah, it makes perfect sense.
Yeah.
And then you had mentioned on the 401k up to $26,500. That's if you're over the age of 50.
You're right. You have a catch up.
Okay,
a
understood.
$5,000 or $6,000 catch up, but they change it every year.
Oh, I think Nick has a question.
I'm going to chime in real quick. Now, could you move over assets, or it has to be cash?
It depends on the provider, okay? And it depends on the institution that you're transferring it over to. All right. So there's what's called proprietary product and non-proprietary product. And not to go into too much detail, but let's just say hypothetically Fidelity, there may be some Fidelity funds that the the receiving firm can't hold.
Okay.
And those would have to be liquidated. So there could be one of the negatives in doing that strategy is there is a time that you are out of the marketplace.
Makes sense.
Both for the transfer and then maybe the liquidation of those products to be moved over.
Do you pay the penalty if you're under 59.5 when you do that?
You're not paying a penalty if you're
'Cause it's
moving
going back into qualified.
That's correct. It's
Okay.
going back into qualified to qualified.
Pretty good.
Yeah.
So how do you think, shifting gears a little bit, how do you feel about dollar cost averaging? People investing X amount of dollars every month forever.
So Warren Buffett's been saying this his whole
Right.
life, right?
That's where I got it
they
from.
think he's boring. I don't know, but he's not.
Yeah.
He's actually right. And you know that's part of my job is sometimes being a psychologist, especially when things are bad.
Uh-huh.
Okay, dollar cost averaging, personally to me, both in my own investment life and my clients, has been the most successful thing you could possibly do. And by the way, pro of 401k, okay, is that people are continuously cost averaging.
You're
Right.
forced to
You're
do
forced
it.
to,
Yeah.
right? You put in that 3% or 4%, whatever your number is, and you continuously cost averaging. They may not even know that they're doing it, okay? They're just looking at their 401k statement, oh, I'm down, or oh, I'm up, or whatever the case may be, but they continue, and that's why they become such effective effective retirement vehicles down the road.
Sure.
That are high valued because they did that cost averaging.
Sure.
But when you have money that you're not forced to do, all right, we have to talk a lot of people down and just, make them I wouldn't say make them. It's their money, their
Educate 'em.
decision, but educate them. And what we'll do is we'll do a lot of that. We'll break out some calculators and some tools that are proprietary to us, and we'll show them, look, if you put money in back in 2000, you put money back in 2008, if you put money back in all of these different during COVID,
Yeah.
okay, you've always made more money. The people that invest when times are bad will always make more money.
Right.
So
No, that brings up a couple great points on it. Either from dollar cost averaging in your 401k, you probably, depending on your income level, you may want to strategize that in a fashion so it comes out pretty much equally over a 12-month time frame and not to front end load it, right? Well, I'm going to put 25% in my 401k in the first 3 months because some plans allow for that. But that kind of defeats the purpose of dollar cost averaging if you've maxed that out.
exactly, and then it just comes down to lucky timing.
Yeah.
Which really I always tell my clients the stock market is the opposite of the casino. All right. The casino,
That's great.
the longer you spend at the casino, all right, and they know this, all right, the longer you spend at the casino, the more money you're going to lose.
Right.
And the stock market or investments in general, you don't have to, just say stocks, but there's a lot of investments. The longer time you're there, the more money you're going to make.
Yeah.
And it's total opposite.
Yeah, that's great. And I hope everyone is a nugget, depending on how savvy you are from an investment standpoint. And you can always reach out to Chris as well. We'll give his number at the end. That dollar cost averaging, my example is $35 a day, or, that's a couple $100 a month. Like, too little is never too little, right?
That's right.
You save what you can save, and over the course of time, that compounds.
That's right. I mean, we have clients that are putting in as little as $100 a month.
Right.
Just something. My own family, my own daughter, excuse me. I mean, she's young, and that's one of the first things I taught her. Put in something.
Right.
It doesn't have to be a lot. Just put in something every month. Let it just come right out of your check. You're not going to feel it.
Yeah.
And put into a separate account. Get that account invested.
You had mentioned earlier about, plans now that you start to see come to fruition a little bit with kids going to school. Could you talk a little bit about the benefits of a 503B? Is it 503B?
529.
Oh, I'm sorry, 529. That's right.
Yeah.
That's a nonprofit. No, sorry. 529 college plan.
529. So we do a fair amount of 529 college plans. It's really the only beneficial college plan that's out there right now.
Sure.
Back in the day, we used to do what's called UGMA, Uniform Gift to Minors Act,
Right.
which was an educational plan. The negative in that plan, one of the big negatives that people saw, was at 18, it was actually the child's money. All right. So that money, you'd actually have to open up an individual account for that child to take possession of the money. All right. We'd all like to think that at 18 years old, our child is going to make the best decision with that money.
Chris and I may or may not have had this conversation off the air about kids.
That's right. But we both know maybe there's one, that may not make the best decision and go out and buy themselves a nice car. So that was a real, turnoff to a lot of people. All right.
Yeah.
So they opened up this 529 plan, and there are a lot of benefits to the 529 plan. Obviously, the biggest benefit is the tax efficiency that money is invested post-tax, after taxes, but that money grows tax-free as long as it's taken for higher education.
Understood.
What a lot of people don't know about that part of the 529 is higher education could be anything tied to higher education, which could be books, which could be housing, which could be commuter costs. There's a lot of things that fit into that category. It's pretty broad. And as long as they take that money, all right, they'll take it tax-free. The second biggest part of that, and I found this with my clients, is child one gets a scholarship, doesn't need the money. You could actually pass that to child two.
Right.
Okay. Child two doesn't go to college. You could pass that to child three. So there's a lot of, and by the way, higher education is not only college. It could be any level of higher education.
Trade school.
Trade school. Yeah. Anything like that. It could be used for as well.
Now, so you don't, as long as you use that money for education, let's say, then you're not going to pay taxes on the growth
Correct.
at all. What happens if none of the kids go to school?
So then that money would be taxed when they take it.
Okay.
It would be a 10% penalty.
Okay.
So it is definitely meant for education.
Okay.
Okay? It
Understood.
would be treated almost like a IRA, like a digital IRA.
And again, we keep talking about time. You can't start that too early.
That's
Okay.
yeah. I mean,
Yeah.
I have clients. I'm talking to clients about starting that when their child is born.
Right.
As soon as the child is born and healthy, I'm talking to them about getting that started. The earlier, the better.
Yeah, and it's hard just coming from a couple of guys with experience with Chris and myself with having older kids. When you have kids and they're 1 year old, you never think they're going to go to. You never think it's actually going to happen, and it does.
Right.
Eventually
That's right.
they actually
They're
are in
actually
school. And you
gonna
have
go
to pay
college.
for
That's
this
right.
stuff.
And by the way, inflation comes into account then too.
Yeah, great
I
point.
mean, think about that. I mean,
Well, that probably goes higher than 3%.
exactly.
Per year, right? Cost
I don't even
education.
know what the inflation numbers are, but they're much higher in college.
Yeah.
So if you're looking at $100,000 education today, that's going to be a lot higher in 20 years from now.
Yeah, that's a great point,
Yeah.
Chris.
So.
So could you help explain to everyone the difference between temporary and permanent life insurance?
Yeah. So well, temporary and permanent could be the same thing. It could be just a term life policy. So
Great point. Yeah.
Yeah. So back in the day in doing this, as an advisor, you learn every day as well. You never stop learning. And I used to really come from the camp of, term is best. Invest the rest.
Yeah.
You know what I mean?
Buy term, invest the difference.
Yeah,
I actually wrote
exactly.
that down.
But,
But why do we know that?
Well,
how come we all know that?
that was just something that came to us, from, I guess, I don't know if it was ads on, I don't know where I got that from. I've just heard it before,
same.
And I fell into that camp.
Yeah.
Term is best, invest the rest. Term is cheaper. And then when I came to my current company, started learning where real wealth is accumulated.
Right.
Okay. And when you hear things that, the 1%ers aren't paying their fair share in taxes, the 1%ers, I'm not going to have that debate or not, but what I will tell you is that the reason they're not paying a lot in taxes is because they know where to take the money from.
Right.
They're not selling investments with huge cap gains. They're borrowing. And where is the borrowing coming from? A lot of time it's borrowing from cash value in their insurance policies.
That's a nugget, guys. I hope you heard that.
They're
Yeah.
smart.
Yeah.
I mean, they're smart. And they'll set these up for their young children as well. And
Right.
we'll have those discussions, of setting up these cash value policies. Are they higher in cost? Yes. Okay, there is an insurance component that's going to cost a lot more than the term part, but that's because they have cash value at the end.
Right.
With the term policy, you use it or you lose it. Hopefully you don't use it.
Right.
So there's a big difference, but you could create a lot of wealth in insurance in certain types of insurance policies.
Now, does an annuity fall into that category as well, Chris?
An annuity will have an insurance component, but
Okay.
it's a totally different type of investment.
I see.
Okay. And annuities, there's a lot of, again, pros and cons to an annuity. All right. And we have to really sit down and when we speak to a client, either a client or a potential client, speak to them if that's going to fit into their investment strategy.
Right.
But there is an insurance component of an annuity, and there's 100 different types of annuities. And I will tell you that I've seen a lot of bad ones out there,
Right.
but I've also dealt with a lot of good ones. And what's great about an annuity is that the insurance part could give you what's called a living benefit.
Okay.
So if somebody comes to me and says, I need $100,000 a year to retire on, and I'm going to ask them, a few questions, and the question that I'll answer a few questions, but the questions I can't answer is, what is the market going to do, okay, over the time period when you're going to need this money, and what are interest rates going to be when it's time to take the money? If you have $1 million saved up and interest rates are 1%, like they were a year ago, that's giving you $10,000 a year. If they're 5%, it's giving you $50,000 a year.
Right.
So an annuity with a living benefit could really come in handy, okay? And again, this is a case-by-case basis, is that we could say, look, regardless of what that market does and that interest rate environment is, if you put this kind of money away, this is how much income you'll be getting at this point, regardless.
Okay.
And that's where annuities could come in really handy.
Yeah, that's great.
Yeah.
Now, variable life, is that a whole life policy where you can pick investments on it?
So a whole life policy, you're invested in the market, okay,
Yes.
and you're invested in mutual funds. It's a little different in annuity. You're also invested in mutual funds, but
Okay.
they just call them sub-accounts.
Got it.
So, yeah. And a negative to annuities is that some, not all, could be very limited to the amount of investment options, which is also a negative, not to go too far back, but also a negative in 401ks.
Yeah, makes sense.
They could have limited options to
Okay.
invest in.
So along those lines, how frequently should people be revisiting their strategy in making sure the money's in the right places?
That's a great question. So the way we do our financial planning is a little bit different. Like I said, we break it down into, a much less amount of pages to go through for the client. And we also give them action items each year that we should be striving towards, kind of goals. Because what you don't want is you don't want to provide a financial plan to somebody, go over it one time, and then leave it alone. Let's face it, it's a working document.
Right.
Okay. Your life is going to change year to year. Okay. There's going to be, may want to buy a second home, or you may want to travel more, whatever the case may be. The market may give you different results than you were expecting. So what we'll do is we'll do a fact-finding kind of exercise with the client. Then I'll work with an outside team who this is all they do. They will share the results with me. I will share those results with the client. We will then, based on what the client's feedback is, give them a proper plan, and then we'll revisit that plan once a year.
Okay.
Yeah, I think once a
Makes
year
sense.
is a fair amount of time, for things to change, and then to re-examine it and see what we want to add.
Do you get a lot of phone calls when the market's so volatile?
Not so much in my practice. I
Okay.
mean, I think our level of education to our clients, and I think the level of reach out is so great
Yeah.
that it's not like our clients aren't hearing from us.
Yeah.
We hear a lot of stories from our competitors or clients that are coming into us that they haven't heard from their advisor when the market's down. And that's one of their biggest peeves. We are very proactive and even more proactive when the market's down. And this really limits our calls. Now we will
makes sense.
we will get the one.
Yeah, sure. We all, yeah.
I mean, it's
People get
it's very
nervous.
common. People
Yeah.
get nervous. I mean, things are, and if they're watching the news, they're even getting more nervous.
Right.
And the media plays a big part in how they feel day to day. And they should never, I tell my team, is that our clients should never feel like they can't call us at any point in time, but we should be making the calls out. They shouldn't have to call us. If they called us because they're nervous, it means we haven't had enough proactive approach.
Yeah,
to
and that
them.
makes perfect sense because people get nervous because they don't know.
Right.
Right.
They
And
don't
it gives
know.
you the opportunity to educate people as to what's going on and what our feelings are short and long term.
Right. Well, this time is different. We
There you
hear
go.
that all the
Yeah.
time. This time is different. The financial crisis is different. The tech crisis was different. COVID is different. Fact of the matter is, it's different. It's it's different, but the outcome is going to be the same.
Yeah,
in
great
which case
point.
you're gonna
Yeah.
have confidence in the United States and
Right.
confidence in the
Stay the
market.
course.
Stay the course. Stay the
Hey,
course.
Chris, we're going to take a quick break and come back. Greg Wareham, Chris DiGregorio will be back with you in 1 sec. Welcome back, everybody. Of course, I'm Greg Wareham with Your Mortgage Process. Our guest today, Chris DiGregorio. Chris, I want to circle back to something. You had mentioned SEP IRAs earlier for self-employed people. How critical is it that someone who's self-employed is investing in a SEP IRA?
Super. Because again, you want that bucket that's at least growing tax deferred. It won't give you a tax-free option, but it'll give you a tax deferred option.
Sure.
Right. So you want to, when we do our financial plans, we actually put it out on paper, different buckets, and one of those buckets is going to be your qualified money and your non-qualified money.
Right.
Non-qualified money, all right, when you're putting it to work is tough. You've already paid taxes on the money you've invested, and now you got to pay taxes on the gains that you've earned. So you're being almost double taxed on the money. So if you're in a 30% bracket, you've already paid 30% on the money going in, right?
Yeah.
And now you're paying 20% on the money coming out.
Yeah, great point.
All right. So the SEP IRA just gives one more option to a self-employed person to put qualified money away. Also, they don't fall under those 401k limits of, either 19 and change or 26,000 and change. They could actually, depending on what their accountant says, and they should check with their accountant first, put sometimes up to $61,000 a year away. So and that's coming off ordinary income.
Yeah, you're not paying taxes on
That's
it.
coming off ordinary income. So if they're in a 30% bracket, they're making $200,000, right?
Yeah.
You put that $60,000 away. Now that $200,000, they just drop their income to 140,
Right.
right?
It's like free money. You're getting a
money.
return on your investment before anything else
Before anything
happens.
else. So,
Yeah.
I mean, even if you put that in, and I wouldn't recommend this, but because it's long-term money for retirement, but even if you put it into something earning 4%,
Right.
you know, they're so far ahead right from the get-go.
No question about it.
You know, so and they could change that. They're not set in stone.
Right.
It's not like you have to do it. Some people think they have to put that amount away, and that's a big misconception. You know,
Well, the accountant will tell you how much you're allowed to
that's
put away,
exactly
right?
right. Yeah, and that's why it's really important that you work with a good accountant.
Yeah.
I'm not an accountant. I can't give accounting or tax advice, but I will work with if they're working with an outside accountant, will work with that accountant throughout the course of the year
Sure.
to make sure that whatever I do, whatever action we're taking for the client is going to fit them best in taxes. So
Yeah,
it's
that's-
important that we work with the other professionals.
Yeah, that's fantastic, Chris. Hey, what are your thoughts on disability insurance? I get hurt. Someone gets hurt on the job, and they have a stream of income coming in. They get hurt in general. You get, God forbid, a car accident or something like that.
Disability insurance is cheap enough for everyone to have.
Yeah.
You know, it's not a high risk insurance for the insurance companies to provide. Okay, so I have had clients. You know, I had one client a few years ago who fell off a ladder.
Right.
And if it wasn't for his disability insurance, he would have been in trouble.
Right.
So I agree 100%. Most employers will definitely give their employees disability insurance options, and they're generally really, really cheap.
Yeah.
So I would always have
That's
that
great.
in
I
my
was
back pocket.
reading somewhere that 20, and I didn't know this, 26% of Americans have some form of a disability.
26%.
26%. I don't know how that equates to permanent and Social Security and all of that. 26, 1 out of 4 people.
Big number.
It's huge,
Big
right?
number. Yeah, big
You're
number.
talking 100 million people.
Right. So I mean, I think disability insurance. I don't know what I mean, maybe $100 a month, if
Yeah.
that, coming out of your paycheck pre-tax. It's
Yeah, how do you
definitely an
go
arrow
wrong?
in the quiver that
So when do you feel someone should make a will?
So it's incredible to me how many high net worth people I meet that don't have a will.
Right.
Okay, and they're leaving it to the state to decide on how their money is going to be distributed, and they're actually going to end up in probate, which could be a lengthy and very costly process.
Right.
So, to me, a will got very important to me when I had my first child.
Yeah.
Okay, when I had my first child, because now that whole and it's I'll tell you, when we went, my wife and I remember that instance where we went to meet the attorney to put together a will. It's a weird conversation. Who am I going to leave my child to if we're in a plane together and it goes down?
Right.
As soon as there's two. I tell clients two things. You should have a will when you start accumulating wealth.
Mm-hmm.
Okay, because you don't want problems within the family. Okay, and you don't want extra costs and probate and all these other things. And you have to have a will when you have a child.
Right.
All right, or multiple children, of course.
Yeah, no, it makes sense.
Yeah.
So I've also seen through the mortgage process over the course of time, I see a lot of trusts.
Yeah.
And people set up trusts. Why would somebody set up a trust? And I know you're not an attorney, but why would they do it?
So a trust, by the way, there's a million different types of trusts, revocable and irrevocable,
sure.
and there's all different types of trusts. But people put money into trust a lot of times to take assets out of their estate is one of the most common things that I see.
Okay.
So right now, New Jersey isn't really dealing with a big estate tax. Okay, I forgot the number, but the number is huge. I mean, you
Okay.
have to be super wealthy. Okay.
Right.
But a lot of times, what they'll do is they'll take certain assets and put them into a trust, and that'll take them out of that estate tax bracket
Got
that
it.
they might have to pay. That's one of the most common
Makes
uses
sense.
of a trust. But if you speak to an estate attorney, there are trusts for everything. Another thing that we've used in the past, that I've spoken to estate attorneys and set up for clients, are charitable trusts. Have you heard anything about those?
No, could you talk about those?
Sure. I mean, a charitable trust is if somebody it doesn't really have anybody to leave their money to, okay, which we have that. I have a client who their husband passed, and she really only has her sister, and her sister is well above her means where she
Right.
could live. So she wants to leave the money to charity. What happens with a charitable trust, which is really cool, is you could take distributions for the rest of your life off that charitable trust.
Right.
All right, tax free, as long as the money goes to the charity that you choose.
Okay.
So you could do a great thing and then live off the dividends, tax free.
Oh, that's great.
Yeah. So it's a great thing we use.
That's fantastic.
Yeah.
And it's special. It depends on the individual.
It
right?
all depends on the individual.
So you could actually have a charitable trust and other trusts. You could probably break things down in a bunch of different ways.
That's right. And the trust will also, and I think we were speaking about this before the podcast, a trust a lot of times will put assets away in certain areas, like property and so on and so forth. It'll separate those assets from, problems with the family. You know what I mean? So when someone passes away, this trust is set up, let's say hypothetically, for a child to get this property, or so it can be used in many different
and we
ways.
were talking about that before, because one thing that you wouldn't want to see happen, will, trust, and part of the value for that is, God forbid something happens. Do you really want the people that are left that are already upset because that individual or individuals had passed away, fighting over money and putting any strain on the relationships, when at that point in time, it's the most important time the relationships have to be tight?
Right. Worst thing in the world. And I've seen it firsthand.
Yeah, it's sad.
I've seen it firsthand, and it is sad. I know I have 3 children. So, the way I put things together is, again, one is always going to be more responsible than the others. But in the same respect, you want to get your affairs in order where it will basically have the least impact on the children.
Right.
That's them, or any of your loved ones that you believe in.
That makes sense.
Yeah.
What percentage of money do you think people should be saving of their income?
So we do something really cool in our financial plans, which is giving us the amount of money that they have left over. Okay. Now, I always recommend an emergency fund, because there's always emergencies. All right. So there's always a percentage of money that should be left over just in case. All right. But for the most part, everything other than that should be invested. Now, when I say invested, there should be buckets. So I'm not talking about invested in an aggressive bucket that's going out 20 years.
Right.
All right. But cash is not king at the banks. I will tell you that right now. Cash is not king. When you're sitting there and you're earning 1/4% or 1/2%, and the bank is going out and lending that money at 4, 5, 6%, that's how a bank becomes a bank. You should have money that's, maybe 6 months out or one year out. You could talk to your financial institutions. A lot of people come to me for cash alternatives.
Right.
So even if you're not invested, so you have your cash account. Okay, there's really no percentage per se. Some people like 6 months of money in reserves. Some people like a year of money in reserves.
Yeah.
The rest of whatever we figure out in the financial plan that they have left over should be invested in one of these buckets.
You got to have your money working for you.
All the time.
And I love the term you use, cash alternative,
Yeah,
right?
that's
Just
right.
because you tie it up for a short period of time doesn't make it any less cash.
That's right. That's
Right?
right. And there are cash alternatives out there. Most financial institutions will offer them. But what happens is a lot of people just use the banks,
Right.
and it's convenient per se. One of the things that we do in our financial plans is we put everything on one page so people could see all their assets on one page, and we don't like large cash balances sitting at banks.
Yeah, it makes sense.
It's hurting their overall picture. It's hurting their future,
It's helping the bank.
and it's helping the bank. Yeah, that's
Being someone who's been in the mortgage industry for 25 years, I've always had the view that mortgage debt is a great debt to have due to some certain tax deductions that you could potentially have with it. In your opinion, Chris, is there anything such thing as a good debt?
Oh, absolutely. Yeah. So there's bad debt and good debt.
Right.
So bad debt is a credit card. You put, $20,000 on it. You buy something, and it takes you 10 years to pay off, and now that 20,000 is turned into $30,000 or $35,000. That's bad debt.
Right.
Buying things you can't afford on credit is bad debt. Buying a car for $200,000 and you make $100,000 a year, that's bad debt. But what is good debt?
Yeah.
So good debt is just like you said. I had a instance not too long ago where a client is buying $1 million home. They have to make a cash offer, okay, to buy this house.
Right.
So they're buying the house $1 million in cash. All right. But then they could actually borrow. Okay, they could actually borrow the money from a, let's say, advisory account. Borrow that money, 3%. Okay, and use that money to buy the house and still have assets working for them. That's great debt.
That is, absolutely.
So, anytime you could borrow at a lower rate than you could make, to me, is good debt.
And again, that kind of goes back to the wealthy. We're talking about that's what wealthy people do. They leverage, and they understand this stuff.
Right.
And if you don't understand it, it's okay. You have people like Chris in the world that can help educate you on this.
Yeah.
So how important is diversification?
Diversification, I spend a lot of time there.
Yeah.
And I'll tell you, this is going back to 401ks. This is where I see one of the biggest problems is that when people choose their 401k options, they're not getting any sort of education whatsoever. So what most people do, I'll tell you, 99% of people do what's done best for the last 10 years, and they're not taking all of the other things into account. And I'm not going to use all of the technical terms that we use in picking out portfolios, but diversification is usually important. Now, what's become very common is target funds and those type of vehicles that your Vanguards and your Fidelities are touting. Okay.
Yeah, just along those lines, I hate to cut you short, but it even goes, there's no education on those because
Zero.
you see them and it's a button that says target 2045 or 2030. That's all you see as the consumer. So you're like, all right, well, I guess I'm retiring here. Hit the button. Right?
Exactly. And that's what they choose.
Yeah.
And there's no transparency.
Right.
There's no transparency to what they own. There's no transparency from the one organization's 2045 fund to another organization's 2045 fund.
Right.
They may have a totally different allocation.
And odds are they do, right?
And odds are they do. So diversification is majorly important. Now, this is an interesting fact that we find in our financial plans, which your listeners may really want to be aware of, is that because of people thinking that their money has to be more and more conservative leading up to retirement, and that is the truth. It does to some aspect. They also have to understand that they may be retired as long, if not longer, than they're working for.
Right.
So in our example of a target fund, it's broken because what happens is, all right, I'm going to retire in 2045. So I'm going to pick a 2045 target fund. At 2045, my money is liquid. It's pretty much in cash right now. It's ready for me. So I don't have to worry about what happened, in 2044. All right. I don't have to worry about the market crash. Right. Great. Now you're in cash. Now it's 2045. You're going to live to 2075. Now what?
Stock.
Well, now you own cash.
Right.
So now what do you do? Start again?
Right.
So diversification, super important to answer your question, but you have to diversify not to the point of where you're retired going completely conservative. You always have to have, something working for you.
Right.
Straight into retirement.
Right.
A lot of people make that mistake.
Yeah. And again, that's a great point on it. Because when you look at as you get older, people are obviously living longer. Everyone knows that. Your average age is 80, let's say on average. Women live longer.
I was going to say for men. Right.
Rightfully so. They're better people than us.
Yes,
So that's another
absolutely.
conversation.
A whole different conversation.
But you're also going to be forced at some point in time to start to withdraw money out of the market.
That's right.
Right? You're 70 and a half, I believe. You have to, or did they increase it?
Out of your 401k, out of your IRA, they increased it now to 72.
Okay.
My presumption and just guess is that'll probably, as people get to live longer, probably they'll change that, make it older. But right now it's 72 years old.
Makes sense. And we will get there. So when you look at these, going back to the 2045 fund, it's kind of like we were talking before when you have a newborn, right? You never really think they're going to college. When you're 51 like me, you really, can you picture yourself retired? No, but it's going to happen.
It's going to happen.
And you got to make sure that you're prepared for it.
Right. And you have to distribute that money properly.
Yeah, I could not agree with you more. When should people start developing a financial plan?
So I will tell you when they should start, and I'll tell you when I see people do it.
Okay. Great.
So I think, again, when you get married, I think that's when a financial plan, well, I shouldn't say when you get married. When you start accumulating a fair amount of wealth, and that could be different to everybody, whatever that number is, all right? You should start a financial plan because a financial plan is giving you so many different things. It's not just giving you how to invest your money, but how to tax efficiently invest your money. Okay. Again, distribution strategies down the road, implementing diversification, which we spoke about. There's so many things within a financial plan that it's only going to help. Right. So, to me, I think at 40 years old is usually the number that I think people should really start taking it seriously. Because let's face it, before then we have children. Most people, not everybody. You're spending a lot of money.
Yeah.
You spend a lot of money then, right?
Yeah.
So it's some of the top money spending years there are. But what I see is most people are between 50 and 60.
Wow.
More people between 55 and 60. And I'm going to tell you why. So what happens, Greg, is they get to this point where they've accumulated this wealth. And sometimes they've accumulated in a lot of different areas. They've accumulated in their IRA. They've accumulated in their 401k. They've accumulated in their whatever, their non-qual accounts, real estate. And they have all these different pieces of the puzzle. and it then becomes really hard to manage it.
Sure.
And it really becomes hard to distribute it and see where that big picture is going to be. And the most common question I get almost every day that I'm doing financial planning is, will I outlive my money? And a good financial plan will reassure you that, you either will or will not,
Yeah. And you know what? You really, we put together plans for so many things in life. I get a workout regimen, right?
That's right.
That's my plan is a
That's right.
workout. This is how I structure myself professionally. And here's my plan as to where I want to get. It just feels like, whether it's through lack of education or lack of discipline, that people don't focus on their financial plan, statistically, don't focus on their financial plan the way they should be. It's as important as your health.
Right. And why do you go to a trainer? I mean, there's a lot of reasons to go to a trainer, but one of the big reasons people go to a trainer is accountability.
Yeah.
And a financial plan gives you accountability because you have different steps you need to take. And we're going to hold our clients to those steps. All right. If they don't do it, they don't do it. But we're going to push them to do it. And they are held accountable to making certain financial decisions that will help them in the future.
Sure. So I was reading through a Gallup poll the other day, and 58% of people own some sort of stock, right? Whether or not 401k, whatever the stock, you know all the different products. And that's down from 62% from 2001 to 2008. And unfortunately, it's a lot lower with people of color. It's even lower than that. I look at that and I say, it's a lot of that's a product of education, right? And understanding what you need to do. How do you think we can go about better educating people?
Well, it's interesting because you've had kids that are either in or out of school. I have kids that are either finished or finishing school. And I think it starts there. I mean, I know that kids don't balance checkbooks anymore like we used to do in the old days. Exactly.
And they never taught it to you in school
They
either.
never taught it to you in school either, right? So, my kids have come out. I've asked them certain questions. Now, I think schools are getting better. Like, I have a really funny story where my daughter, when she was in school, she was in an investment club and she had to pick 20 stocks. And I'm looking through her stocks and she has Apple and she has Amazon. And then all of a sudden I look and she has Carnival. And I'm thinking to myself, Carnival? I go, honey, she was real young at the time. She must have been 7 or 8 years old. I go, Hon, why did you pick Carnival? She goes, Dad, I love carnivals.
Go all in. I'm all in.
I love carnivals.
Oh, that's fantastic.
I love carnivals. and that's why she
love
did Carnival,
kids.
I thought it was the funniest story, but the fact of the matter is they have to do better, I think, in school, of educating people. And I think there's another phenomenon that's come around recently, and that's the phenomenon of certain institutions there's a lot of different things people could invest in now, and the ease of investment has got so easy. And what that's done is push people into making their own decisions, especially when they're young, and they get bad taste in their mouths because they have bad decisions. No one's teaching them from these certain institutions, put your money away, put it in good quality companies. Let those qualities earn in dividends and dividend reinvestment. No, they want to get rich quick.
Crypto.
Yeah, there you go. As a perfect example. And they have a bad, I have a restaurant owner who's very wealthy, but doesn't have a lot of money invested. And I just started working with him. And why? He had a bad crypto. He had a bad, he might have invested in a stock that was a meme stock. I'm not going to mention names, that, he's trying to get rich on.
Yeah.
And in my opinion, yes, there are people that probably get pretty lucky. But now we're talking more about luck than
And
investing.
when you look at something like crypto, and I'm not saying anything negative about it because some people have made a lot of money doing it. How do you even begin to understand what the product truly is, right?
That's right.
And I'm relatively well read on different things, trying to understand blockchains, and it's overwhelming. Do you have any experience with crypto at all?
I feel the same way as you do.
Yeah.
I kind of teach my clients, and I was kind of taught this early in my career, and I've kind of stuck by it, is I want to invest in things I understand.
Yeah.
Okay? I want to invest in companies that make money,
Yeah.
all right, and that have been around forever. Soon as you get outside of my understanding of what it is, then I'm not really interested in it. Definitely not for my clients. Definitely not for my. And crypto has always been I would say, a mystery to me.
Yeah, same. And again, I'm not saying anything bad about it. Maybe I just don't understand.
Could be great.
Maybe I'm just an old man. I don't understand
me
it.
too.
Therefore,
Could be great.
I stick with things that I know. So what's your feeling on where the stock market's going? We know it's been volatile this year.
It has. Look, this time is different.
You're talking about that, yeah.
This time is different, right? So we have inflation, and we have it's still an ongoing war in Ukraine and Russia, and we have rising interest rates. And what's been different about this market, before I go to where I think it's going to end up, is what's different about this market is people aren't getting a lot of that 60-40 split or that 50-50 split in bonds and stocks, bonds and equities isn't saving them this year.
Right.
That's different. That's different than
You're
I've
right.
seen
Yeah,
in a
I've noticed
long
that.
time,
Sure.
where interest rates are going higher. So it's lowering the value of their bonds. And I
Yep.
think the aggregate's down about 10% this year. And then stocks are going down as well, where usually they have an
You
inverse
usually don't see
relationship.
both at the same
You have
time.
an inverse relationship.
I couldn't agree with you
So
more.
those portfolios aren't working, and we've put together a lot of strategies to put alternatives together and stuff like that. As far as the market and where it's going to go, I will tell you this. I never know where the market's going to go. But I know over the long term, I believe the market's always going to go higher.
Yeah.
But there will always be bumps in the road. There'll always be different times. And we're just dealing with a very different time right now.
I at times feel that the market runs on fear, right? Because you see these wild shifts in the marketplace. And just as a layperson looking at it, and I pay attention to this stuff, but I would never call myself an expert. I go, gosh, all right, well, if stock's dropping day, let me use Amazon as an example. Well, stock goes down. Well, has anyone hit the button any less to have something sent from their house yesterday as compared to today, right?
Right.
Earnings that much more impacted. Like I feel at times nothing really fundamentally changed, yet you see these, aggressive drops.
Right.
And
again, well, yes, fear is the biggest thing, right? Because you're right. Nothing fundamentally has changed. I mean, companies, they report their earnings. You kind of know what they're kind of doing, and you know what a good company is and what a bad company is. A lot of people this year, they got stuck in, and we were totally against it, in some of these high growth multiple companies where they're trading to a price where they would have to earn 100 times, 200 times more than they're earning. A lot of people got stuck in those traps this year that we tried to help people in. But yes, in a case like Amazon, no. I get 9 Amazon packages a day. Me personally, I'm supporting Amazon, So, I mean, Amazon, Apple, I'm buying Apple products. I don't even know why I buy them. The phone's always the same, but I buy it, So these are good companies.
well, it just shows up.
Yeah,
Somehow the chart shows
exactly.
up. It's a kid factor.
Yeah,
It's the kid
exactly.
curve.
You need an Apple 13 and, and all of these different phones and iPads and stuff. They make it smaller, bigger, and you buy it.
Right.
So these are good companies, Walmart, these are good companies, the companies that are going to thrive. So why do they go down? Yes, they go down through fear is one of the big things, right? And people just saying, oh, well, everything's going to go down. Company hasn't changed, but I'm going to sell.
Right.
But you got to also understand it's a big institutional factor out there too, which you got to look at, It's not the me and you who's moving the market. It's the institutions and it's the algorithms that move the market. And those algorithms are way, I wouldn't say smarter than me. They're way ahead of what they have their own set of rules. And if they see certain things, these algorithms are going to sell.
Yeah, and
that's why you see those big drops.
That's like 70% of the market now. It's just algorithms.
Algorithms. It's not just you and I. Now, if you understand that, it gives you even more of a chance to buy these companies at a deeper price.
Sure.
And it's a very old saying back in the day, but if you liked it at this price, why don't you like it when it's on sale at this price?
Right.
But we're in the only industry where people run away from sales.
That's
when,
great.
When something's on a sale, they run away.
That's fantastic, Chris.
But it's hard. You gotta be courageous.
No, it is. I mean, even if I go back to 2008 when stocks were plummeting, 2009, right in that time frame.
2008, it was a
right?
big one.
So you get the banking stock. I've been in banking forever, right? Banking stock is plummeting.
Yeah.
People are running away from it.
That's right.
But at the end of the day, now those stocks are worth a ton of money.
That's right. And if you invested in it then, I mean, I remember Ford back then and all of these
Right.
different, I mean, I remember
Citibank.
Ford bonds trading at 9 cents on the dollar back
That's hard to
then, So yeah, I mean, and again, there was some
There's fear.
messes in 2008 as well. I don't think we're in a 2008 right now. There was some real fundamental challenges that banks had taken on back then.
Yeah, no question.
A different time,
and
I
don't think we'll see that again.
I think there's a lot of things in place.
Yeah.
We may see something different. There's a lot of things in place now, and the banks are held a little bit more accountable than they were back then. And
Sure.
back then it was the mortgage crisis and so on and so forth. But now I think that we're at a different time. But again, the same thing will play out. I mean, look, even in the COVID crisis that we just went through, look at where the market had bottomed out at,
Right.
and now who was investing during the COVID time? And let's face it, we were in a lot of fear during COVID. I don't think investing was on the forefront of everybody's mind.
Sure.
But if you had invested on those dips and when the Dow, if you remember the Dow was trading down 2,000 points one day, 3,000 points.
Yeah.
Think about where you would be today. So what I see is when we do our portfolio management is the person that held versus the person who cost average, going back to your point.
Yeah.
Person who held will get back.
Right.
The person who cost average will get back quicker. Just the way it is.
It's a nugget, guys.
Yeah, just the way it is.
So give me one piece of advice, Chris, that you'd give to someone looking to develop a financial plan.
Get started. Do the homework.
Yeah.
Right? So a financial plan takes a little bit of work from their end. You know, they have to put together their financial statements. They have to put together a budget. That's sometimes we'll do it with a budget, sometimes we're not. But at least we have to have a good understanding of what they're, spending.
Sure. I think people don't know sometimes.
A lot of people, they don't know.
Yeah.
And a lot of times it's interesting in a relationship how one person doesn't know. You know what I mean? We'll sit down and they go, oh, we're spending that? Yeah, we're spending that, So it's interesting. And that's why I like to meet a lot of times in our practice, we like to meet the spouses,
Sure.
and the couples together and not just one, because they could have very different outlooks on what they're spending or even what their future may look like,
Right.
So spending is a big part because what we want to do is get out of the spending part of it, the financial plan, is find out where the excess is
Right.
and how that excess could be best utilized.
Sure.
So I think people, I think financial plan, is, to answer your question, it's a broad term. And I think people get a little nervous about it, okay?
Right.
Because maybe they've got one that was 100 pages and they couldn't disseminate through it. Or maybe they think it's a huge cost, to do it,
Sure.
Which it's not, by the way. At least not through our practice. People charge differently. So I would say the first thing you have to do is start. Don't be afraid of it. Start. Without, what do they say? Without you plan to fail, you fail to plan.
Yeah.
Right? And it's the same in financial
No question.
planning.
Maybe they're even a little bit afraid. They don't want to know. Like when you start doing expense management, I do it because I do it. And I
Right.
keep a spreadsheet, and you look sometimes, you're like, oh my gosh, where do we spend all this money? And
Right.
where do you, right? Because you
Right.
got a lot of kids, you got a lot of things going on. And I think sometimes people, they don't want to know.
Right. Or we're dealing with business owners. The
Yeah.
business owners know how much you're spending in their business. They have to. They have to have a
Right.
P&L, right? But they don't know how much money they're spending in their personal life.
Right.
And going back to your example, even $35 a week or a month, whatever the number was, it adds up over time. If you buy something for $1,000 that's frivolous, it didn't cost you $1,000. It cost you $1,000 plus 7% compounding over the next 30 years.
Yeah. It's a great point.
That doesn't mean, I've heard some people say, don't buy your Starbucks. People are still going to buy Starbucks, but at least look, at what you're doing.
At least
and
understand what
the
that
impacts.
decision is.
Absolutely.
Think like the wealthy people.
That's it.
So, Chris, I really appreciate you taking the time today. It was fantastic, man. Thank you.
Well, I appreciate you having me. And if anybody needs some information from me or education, I could be reached. My cell phone number is 718-614-6024. Or my office number is 732-967-2665.
Yeah, and your office is in Homedale, New Jersey. And can you give the phone number one more time?
Sure. 732-967-2665.
Fantastic. Chris, fantastic. Thanks for
Absolute
spending
pleasure.
the time.
Thank you for having me, Greg.
Appreciate it. We appreciate everyone listening out there. Again, Greg Wareham, Chris DiGregorio today. Please, we look forward to catching up with you next week, and we appreciate you listening today. Thanks, guys.
Thanks again.
Thank you for tuning in to this week's edition of Your Mortgage Process, hosted by Greg Wareham, produced by Greg Wareham and Nick Pavis at The Social Rift, and executively produced by The Social Rift. Thank you again for tuning in, and we look forward to catching up with you next week.